I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Disclaimer: this video does not infringe on the copyrights of the book's author, as this video is based on the fair use doctrine, explains my own opinion about the book, and does not use any direct text from the book. 1. Technical analysis is a method of analyzing financial markets by examining past price and volume data to identify trends and make predictions about future price movements. 2. Technical analysts use a variety of tools and techniques to analyze market data, including charts, indicators, and patterns. 3. Price charts are a key component of technical analysis, and different types of charts can be used to analyze different aspects of market data. 4. Technical analysts use indicators to help identify market trends, including moving averages, oscillators, and momentum indicators. 5. Chart patterns, such as support and resistance levels, can help identify potential buying or selling opportunities in the market. 6. Technical analysis can be used for both short-term trading and long-term investing, depending on the investor's goals and risk tolerance. 7. Risk management is an important aspect of technical analysis, and investors should always be aware of the potential risks involved in any investment strategy. 8. Technical analysis should be used in conjunction with other forms of analysis, such as fundamental analysis and market sentiment analysis, to get a more complete picture of the market. 9. Technical analysis is not foolproof and should not be relied on exclusively for investment decisions. 10. Technical analysis can be a useful tool for both novice and experienced investors, but it requires patience, discipline, and ongoing education and analysis to be successful. Technical analysis is a way of studying the financial markets, like stocks, currencies, or commodities, by looking at how prices have moved in the past. By analyzing this price data, investors try to identify patterns and trends that can help them make predictions about where prices might go in the future. It's like looking at a map of a city to figure out where you want to go next. By studying the streets and landmarks, you can get a better idea of the best route to take. Similarly, by studying past price movements, investors can try to find the best route to take with their investments. Technical analysts use a variety of tools and techniques to analyze financial markets. One of the most important tools they use is price charts, which show how prices have moved over time. These charts can be used to identify patterns and trends in the market, such as whether prices are rising or falling, and whether there are any key levels of support or resistance. Technical analysts also use other tools called indicators, which are mathematical calculations based on the price and volume data, to help identify market trends and potential buying or selling opportunities. Think of indicators like a flashlight. They shine a light on what's happening in the market and help investors see more clearly. Price charts are a key component of technical analysis, and there are different types of charts that can be used to analyze different aspects of market data. The most common types of charts are line charts, bar charts, and candlestick charts. Line charts show the closing prices of an asset over a period of time and can help investors identify long-term trends. Bar charts show the high, low, opening, and closing prices of an asset for a specific period of time and can help investors identify trends and patterns in the market. Candlestick charts are similar to bar charts, but use a series of colored candles to represent price movements and can help investors identify support and resistance levels, as well as potential buying or selling opportunities. Think of charts like a picture book that tells the story of how prices have moved in the market. By studying the pictures, investors can gain insights into what might happen next. Technical analysts use a variety of tools called indicators to help them identify market trends. Indicators are mathematical calculations based on the price and volume data of an asset. There are many different types of indicators, including moving averages, oscillators, and momentum indicators. Moving averages are lines that smooth out the price data and can help investors identify the overall trend in the market. oscillators are indicators that move up and down between two extreme values and can help investors identify overbought or oversold conditions in the market. Momentum indicators measure the speed and direction of price movements and can help investors identify potential changes in the trend. Think of indicators like a doctor's instruments. Just like a doctor uses instruments to measure your health, investors use indicators to measure the health of the market. Chart patterns are another important tool used in technical analysis. Chart patterns are visual representations of the price movements in a market, and they can help investors identify potential buying or selling opportunities. One common type of chart pattern is support and resistance levels. Support levels are prices at which investors tend to buy an asset, while resistance levels are prices at which investors tend to sell an asset. By identifying these levels on a price chart, investors can look for potential buying or selling opportunities when the price reaches these levels. Another common type of chart pattern is a trend line, which is a straight line that connects two or more price points and can help investors identify the direction of the trend. Think of chart patterns like a puzzle. By studying the pieces and how they fit together, investors can gain insights into how the market might move in the future. Technical analysis can be used for both short-term trading and long-term investing, depending on an investor's goals and risk tolerance. Short-term traders typically use technical analysis to identify short-term trends and trading opportunities that last from a few minutes to a few days. They may use indicators such as moving averages and oscillators to identify entry and exit points for their trades. Long-term investors, on the other hand, use technical analysis to identify long-term trends and to determine when to buy or sell an asset. They may use indicators such as trend lines and moving averages to identify potential buying or selling opportunities. It's important to note that while technical analysis can be a powerful tool for traders and investors, it's not foolproof, and there is always risk involved in any investment strategy. Technical analysts must always be aware of potential risks and be prepared to manage them. They must also be disciplined in their approach, following their trading plan and not allowing emotions to influence their decisions. It's also worth noting that technical analysis should be used in conjunction with other forms of analysis, such as fundamental analysis and market sentiment analysis. Fundamental analysis looks at a company's financial and economic data to determine its true value, while market sentiment analysis looks at the overall mood of the market and how investors are feeling about the asset in question. By using multiple forms of analysis, investors can get a more complete picture of the market and make more informed investment decisions. Point 7 in the book Technical Analysis for Dummies explains that technical analysis can be applied to any type of financial asset, not just stocks. This means that investors can use technical analysis to analyze the price movements of a variety of assets, including currencies, commodities, and bonds. For example, technical analysis can be used to analyze the price movements of currency pairs in the Forex market. Forex traders often use technical indicators, such as moving averages and oscillators, to identify potential buying or selling opportunities in the market. Similarly, technical analysis can be used to analyze the price movements of commodities such as gold, oil, and agricultural products. Technical analysis can also be used to analyze the price movements of bonds, which are debt securities issued by companies and governments. Bond traders may use technical indicators, such as trend lines and moving averages, to identify potential changes in interest rates, which can have a significant impact on the price of bonds. It's worth noting that while technical analysis can be applied to a variety of financial assets, the effectiveness of technical analysis can vary depending on the asset being analyzed. For example, some financial assets may be more volatile and subject to sudden price movements, while others may be more stable and predictable. As with any investment strategy, it's important for investors to do their own research and due diligence before making any investment decisions. Point 8 in the book Technical Analysis for Dummies explains that technical analysis can be used in conjunction with other forms of analysis, such as fundamental analysis and market sentiment analysis. Fundamental analysis involves examining a company's financial and economic data to determine its intrinsic value. This can include analyzing a company's financial statements, management team, industry trends, and macroeconomic factors. By using fundamental analysis, investors can gain a deeper understanding of a company's long-term growth prospects and value. Market sentiment analysis, on the other hand, involves examining the overall mood of the market and how investors are feeling about a particular asset. This can include analyzing news headlines, social media sentiment, and trading volume. By using market sentiment analysis, investors can gain insights into how other market participants are thinking and feeling about an asset. By combining these different forms of analysis, investors can get a more complete picture of the market and make more informed investment decisions. For example, a technical analyst may use technical indicators, such as moving averages and trend lines, to identify potential buying or selling opportunities, while also using fundamental analysis to evaluate the long-term growth prospects of a company. They may also use market sentiment analysis to gauge how other investors are feeling about the asset in question. It's worth noting that while using multiple forms of analysis can be beneficial, it can also be time-consuming and complex. Investors should be prepared to put in the necessary time and effort to thoroughly analyze an asset before making any investment decisions. Point 9 in the book Technical Analysis for Dummies explains that technical analysis is not a standalone strategy and must be combined with proper risk management techniques to be effective. Risk management is the practice of identifying, assessing, and controlling potential risks that may impact an investment strategy. In the context of technical analysis, this means using tools such as stop-loss orders, position sizing, and portfolio diversification to limit potential losses. Stop-loss orders are a common risk management tool used by traders and investors. A stop-loss order is an order placed with a broker to automatically sell an asset if it falls below a certain price. By using stop-loss orders, traders and investors can limit their potential losses if an asset's price falls unexpectedly. Position sizing is another important risk management tool. Position sizing involves determining the appropriate amount of capital to allocate to each trade or investment. This helps ensure that losses are limited and that the overall risk exposure of the portfolio is balanced. Portfolio diversification is also critical to effective risk management. By diversifying their portfolios across multiple assets, investors can reduce their overall risk exposure and limit the impact of any single investment on their overall portfolio performance. By combining technical analysis with proper risk management techniques, investors can better manage their risk exposure and increase their chances of success over the long term. It's important for investors to develop a comprehensive risk management strategy that takes into account their investment goals, risk tolerance, and overall market conditions. Point 10 in the book Technical Analysis for Dummies explains that technical analysis can be a valuable tool for traders and investors, but it is not a guaranteed way to make profits. Technical analysis involves using past price and volume data to predict future price movements, but there are no guarantees that past performance will continue in the future. Market conditions can change quickly, and unexpected events can have a significant impact on asset prices. Therefore, it's important for traders and investors to approach technical analysis with a healthy dose of skepticism and to use it in conjunction with other forms of analysis, such as fundamental analysis and market sentiment analysis. Additionally, traders and investors should be prepared to continually adapt their strategies as market conditions change. This may involve adjusting their technical indicators, using different time frames, or changing their risk management techniques. Ultimately, successful trading and investing requires a combination of skill, knowledge, and a bit of luck. Technical analysis can be a valuable tool in the investor's toolkit, but it should not be relied upon as the sole means of making investment decisions. Instead, traders and investors should use a well-rounded approach that takes into account multiple forms of analysis and effective risk management techniques. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.